How many of your people are back in the office? What's the return to work look like for Goldman Sachs M&A?
Well, it certainly varies around the world. In New York, a vast majority of our people are back in the office. It's made a big difference. It's great to have teams back together.
It's made a big difference. It's made a positive difference to have them back in.
No question, for the culture, for being able to work together. In fact, for our clients, we view being together and being at our clients as a critical part of return to office, and also delivering what we view as the best client advice that we can do. So it's been fantastic for the team. We try to make it as enjoyable for folks to return. And I think our junior folks, senior folks, it's been fantastic for the culture.
As Matt alluded to in the setup there, you've had this record run first half of the year in M&A. We had a pretty good last quarter to 2020. But you guys look forward, and you obviously have a robust pipeline that you can see into. What do you see going into the second half of this year? Is this sustainable, or are we going to go back to a sort of more depressed M&A environment?
It's interesting. The first half was certainly record, as we all talked about. But I'd say our clients, I wouldn't say they got everything done or close to what they wanted to do. The repositioning that we see coming out of COVID, and hopefully we continue to see progress coming out of COVID, is a structured repositioning in many, many industries around the world. And whether that's industry leaders who benefited during COVID, or whether that was folks who struggled during COVID, the lens is fundamentally different. And our clients, in the dialogue that we've seen, is at or higher than the levels we saw in the first half, as clients continue to think about what is the right next move. Their boards are supportive, their investors are supportive, and that's really what's driving continued dialogue.
And what's going to, what is the composition of the deal environment going to be in the second half of the year? Because obviously, as Matt said, we've had this pretty tough stance on regulation. We've had Biden come out and saying he wants to improve competition. We know Lina Khan at the FTC is particularly against sort of big tech getting any bigger. So are we going to just see a lot of smaller sort of $1 to $5 billion deals, or are we going to see the kind of mega cap deals that we all get pretty excited about?
I think at whatever year you look at in history, we've worked with our clients, their counsel, with the regulators on transactions. We don't expect that to change. Obviously, there's been some announcements and changes that are in transition, but we'll continue to work with clients much as we have as they go through it. The dialogues that we're having continue across the spectrum of size. You saw some large transactions. In fact, you saw one this morning. And we would expect those dialogues and repositionings to continue. Obviously, the vast majority of transactions, when you do it by transaction count, are in the smaller or mid-sized category. But that's no different than any prior years or prior decades that we've seen in the M&A market.
Right, and that's, I assume you're talking about the Zoom 5.9 deal. It's a big number, I think 15.7 billion. And it doesn't seem like one that's necessarily going to hurt competition, right? I mean, you can do deals that aren't necessarily anti-competition.
Certainly don't want to comment on that or any specific transaction in the regulatory reviews.
Of course not.
Certainly, many transactions across the spectrum have been very good for consumers. Whether it's taking cost out, whether it's structurally improving industries or access, again, we would expect that continue, and you see that benefit across smaller and all the way through larger transactions as well.
What do fees look like right now? What kind of pricing power have you got? I mean, you're king of the hill, obviously, but everybody's flush with cash, right? Deals are going for big premiums. Are you getting a bigger piece of the pie?
What I'd say, and again, our market shares, we think, have been very good, but it really drives from being in the boardroom, being with clients, giving strategic advice, having the long-term relationships where we focus on the long-term benefit to our clients. And when we see our clients do well, of course, we would like to do well, but we want that to be commensurate with our clients doing well. And that's how we've always thought about the strategic business. When our clients do well, we do well, but it takes years of investment, years of advice, and years of spending time with clients, helping them think through their biggest and most important strategic initiatives.
Stephan, help us characterize the SPAC boom. It feels like we're sort of late stage there. Is this something we're going to look back on and say a lot of people just lost their heads here, a lot of bad deals were done at inflated valuations? Or are people going to say, actually, this was a smart model and it's something that is going to continue to have legs going forward into future M&A markets?
Look, I think hindsight is to be determined on all of the SPAC transactions. I would say it continues. Not in the volumes that we saw previously. It addressed the portion of the market that addressed the need for certain clients. And when that happens, you see transactions happen. I expect it to remain part of the market. How big, we shall see. But it certainly served a part of the market, and I would expect part of that market to continue. We've seen transactions today that were SPACs as well as over the past week, and expect that to continue as part of the second half.
And how much is in the pipeline? You know, I mean, a lot of the bubble that we see on our screens is just the capital raise, right? And it hasn't all been spent yet.
That's true. There are a very substantial number of SPACs still looking for companies to do transaction with. But there's a massive amount of private equity capital, a massive amount of venture capital, family office capital, sovereign wealth capital. So it's one pocket of capital that's very substantial. But when you talk about what we've seen in the M&A market, it's being driven by 5 or 6 or 7 very large pockets of capital that are looking to make investments. That's just one of them, but certainly SPACs have a timing element to them that some of the other pockets don't, that is driving some of the transaction activity.
And the sort of more vanilla deal financing that we think about driving traditional M&A, is that still there, and are you expecting that to remain in place through the rest of the year?
The financing markets and the access to capital is ubiquitous, whether it be the banks, whether it be direct lending, whether it be, again, private equity with structured capital that can play both equity and debt. The financing for transactions is there, and if strategics are looking for whether it be partners or private equity or just straight debt, the markets are wide open.
I figured there's a few pieces, some moving parts that you have to take a view on when you're advising clients. Rates must be one of them, right? I don't think anyone really, there are very few people who expected to see rates continue to drop the way we're seeing it. How does that affect your business, and where do you see them going?
Well, rates, no question, when you think about debt capital, have driven the cost of capital for acquisitions to be very, very attractive. We haven't seen major moves in the financing costs on the debt side, so we expect that access to capital in the debt markets to continue. Going forward, we'll see how the markets respond and whether it heats up and drives interest rates or the governments take action. But right now, the interest rates and the cost of debt remain, as they have been for quite a period of time, incredibly attractive.
The other thing I think of, and I'm sure it's in the smaller subset of deals in terms of the price tag, is the capital gains talk. You know, we heard at the beginning of the year a lot of companies say, oh, if Biden's going to double capital gains taxes, I'm going to sell out now. Did you hear some of that talk? Do you still hear some of that talk?
There was some dialogue. You know, where taxes end up, we'll see. Obviously, there's a lot of discussions going on. There were some sellers that focused on that, but I'd say the vast majority of transactions were focused on, is it the strategic, correct, and right thing to do, not timing taxes or trying to time any specific issue.
Stephan, I want to pull back on something you talked about at the top, which was these companies who are still going to do deals because essentially they didn't get everything they wanted to get done during the last period of time. And I wonder why, because it has been such a favorable market. You've had so much access to capital. You've had a relatively relaxed regulatory environment, and you've had shareholders willing to cheer on seemingly any deal. So why would companies at this point be saying we haven't been able to do the stuff we want?
Well, markets are evolving. Company strategy evolved. We're still obviously dealing with COVID around the world. And so it's an evolving landscape as people think about their strategy. So it wasn't as if companies said last year, I want to do X, and they just haven't gotten it done. It's, let me think about my strategy. How should that evolve? Some knew right away and had ideas what they wanted to do. Some thought over a period of time, and it's been an evolution. So all I say that is because the dialogues just continue at an incredibly robust level. Some people trying to get done what they've been trying to do for a while, and some with evolving strategies thinking about the next step, which could be 1, 3, 5, 10 years down the road.